Are you going to make money or lose money in the markets in 2023? I'm Doug Ray, president and founder of the Wealth Guardians and the Ray Financial Group.
And I'm Brice Payne, and you've entered The Vault, the Wealth Guardians video series on all things pertaining to retirement planning. In this episode, we're going to cover what the markets did in 2022, how we think the markets will trend in 2023, and why. Remember, don't forget to hit the like and subscribe buttons below, and let's go ahead and get to it. Doug?
Yeah, so let's, in the lead up to what we think is going to happen in 23, Brice, let's talk about 22 because it set the foundation for what I think will happen in 23.
Fair enough.
Everybody realizes that last year we dealt with a huge dose of inflation. I think at one point in time it was running over 9%. That's the CPI index. That's what the government tells us. Honestly, if we're honest with ourselves, we know it was impacting families more than that. All you have to do is look at what gasoline did, what eggs did, chicken, meat, you name it, everything was going up. So the Federal Reserve does not like inflation. They have to be there to combat inflation. Their target goal is 2% a year. The way the Federal Reserve targets inflation is by raising interest rates, specifically the Fed funds rate. So with an inflation rate of over 9%, they had to start increasing interest rates. Technically, it's been said that in order for the Fed to be effective, they have to get the Fed funds rate above the inflation rate.
Right.
Well, back when they got started, the Fed funds rate was nearly zero.
Right.
So that's a lot of increases. Well, sure enough, they did. In 22, they set about increasing interest rates pretty dramatically. I think it was 3 times, Brice. They raised it by 75 basis points. That's 0.75%.
They did it frequently, and they did large jumps, not just moderate ones.
They did large jumps, and that is unusual for the Federal Reserve System to do that. Most of the time, their increases are 25 to 50 basis points,
and not as close to each other as we saw them in 2022, which means tells me that perhaps the Fed was caught a little bit on their heels as to how to deal with it, and they were trying to catch up.
Oh, I think they definitely were caught by surprise, and they did have to do a catch up. Now, what happens when you have higher interest rates? Well, that's going to slow the economy, which is exactly what the Fed was trying to do. I mean, just look what happened to mortgage rates in the matter of a year. They went from under 3% to close to 7% now. Automobile interest rates, the same thing. But inflation has moderated some. It started to come down. It's not 9% anymore. So it seems to be having some sort of an effect.
Some impact. Perhaps not enough yet, though.
Not enough yet. And you know, the other negative side effect of higher inflation rates is what it does to the stock market and the bond market.
Right.
Both lose, both go down, both lose money for you. So we had a bear market in 22, started in early January. So that kind of leads us up to 23. What do we think is going to happen here in 23? You know, right now, as we sit here in mid to late January, the market thinks that the Fed is pretty close to stop the increase in interest rates and maybe even pivot and start going down. That's why we've had a bit of a rally effect going on. I'm not sure that's going to happen. So I want to kind of back up a little bit and explain to you some tools that we use to predict how the markets may go in the new year.
Okay.
One of them is called the Santa Claus Rally.
Okay.
The Santa Claus Rally is defined as the last 5 days of trading in that year, which is the last 5 trading days in December, and the first 2 trading days
in the next year
in January. That's right. It's simple. If that's positive, then the statistics say that 7, 8 times out of 10, we should have a positive overall new year. It doesn't say how big a positive,
Right,
it just says
just
positive.
impository, about 75% of the time this will ring true.
Yeah.
Okay.
So if we go back and we look at last year, we've got a chart for that you can see.
So what we're looking at here is December, the last few days of December of 2021 going into January 2022.
Right. So if we look at that, basically we were flat the last 5 days, and then the last couple of days things perked up just a little bit. We went up, and then kaboom!
Right.
The bear market actually kicked in. I think it was that third trading day actually in January of last year, and from January through the end of the year, the Dow and the S&P, which are the two big indexes, they were down well over 20% each, and the NASDAQ at one point was down over 35%.
So indications came true for that. If we looked at what happened at the end of December 2021 into the early January 2022, there was not a rally there. It did not go in positive territory. And by the end of the year, by the end of 2022, that Santa Claus effect proved to be true, and there wasn't one.
That's correct.
Okay.
Sure did. So it worked then. All right, let's take a look at a chart now of the
Okay.
Santa Claus rally.
So this is December 2022 going into the first part of January 2023.
Right. So the last 5 trading days, we have basically essentially flat period of time. And then boom, in January, it starts to take off again. And
Okay.
we've had a nice little rally. Remember a moment ago, I said Wall Street right now thinks that the Fed may be close to their increasing the interest rates and may even start to pivot. That's what the market's trading on now.
Okay.
So we'll see what happens here in the next several days as this thing plays out for January. So that leads us to, okay, we have a situation where right now we've got a promising Santa Claus effect.
We'll have to wait 11 more months and see if it comes true or not.
Exactly. Now, what do we think is going to happen in
Okay.
23?
Let's talk about the January effect.
So the January effect basically says, as January goes, so goes the market.
All
Meaning
right.
that if January is positive, then the rest of the year should be positive.
How often does that come to fruition?
Again, it's about 70-80% of the time.
Okay.
So
All
it's
right.
pretty good.
Better than a coin flip.
Yep. Now, if January is negative, the market ought to be negative. So we'll have to see what that plays out this year, because we're not quite at the end of January as we record this show. Now, let's get back to where we think 23 is going to take us.
All right.
I don't want to be negative on the market, but I have to be this year. I don't think we're done with the bear market yet. We still have relatively high inflation.
All right.
The Fed funds rate is only at 4.5%. We're probably going to see several more increases, maybe not 75 basis points, maybe a half, maybe even a quarter. But still, we've got several increases ahead of us.
Okay.
That is going to have a negative effect on the overall market.
Of course.
Now, as we go through this period of time, the market's going to start to lose steam. I personally think it's going to take at least until late summer, early to mid-fall before we finally find a bottom.
Okay.
I think we've probably got another 20-25% to go on the downside.
You know, I was saying in spring of last year that it would be around late spring or early summer of this year that we would finally hit bottom, and I've kept extending that. The longer we went into 2022, I kept slowly extending that, and so I'm starting to agree with you now that it will be at the very soonest midsummer, if not late summer, that we see it bottom out.
I think that timing is going to be pretty good. We'll have to wait and see. There's a lot going on out there. Still got this Ukraine war going on.
Sure.
A lot of geopolitical situations happening. But the other thing that tells me that right now the market's wrong about having seen a bottom is we haven't seen what's called capitulation.
Okay.
Capitulation is basically The market's been going down, and the most bullish of investors finally say, okay, I can't take anymore.
Throwing the hat in the ring.
I'm done. I'm out of here. I'm throwing the baby out with the bathwater. Okay. There is a tool that we use that tells us what that capitulation looks like.
We do.
It's called the VIX index, VIX. It's a measurement of how much fear is in the market. And honestly, the last several weeks, there's almost been no fear whatsoever. Stay tuned for our next show. Brice and I are going to show you what capitulation looks like on the VIX index, and we're going to show you a graph of what the VIX looks like today and what it looked like at capitulation back in 20, that bear market, and more importantly, back in the 2009 end of that bear market. I'll tell you about that one. I actually saw the day of capitulation. I was in my office. I had one of the business shows on, and they run the ticker at the bottom of the screen. And that whole week, the market, the Dow had been dropping every day, 1,000 points, 1,000 points, 1,000 points. And this time I was actually looking at the S&P 500. And that day too, Dow was going down, the S&P was going down. And I guess it was about 2:30 in the afternoon, it stopped. The S&P slowed down. It stopped at 666. And I'll never forget that because it was kind of chilly. It's turned around. It started going up slowly, then faster and faster. It finally closed at 4 o'clock. The next day it opened higher, and then it never looked back.
And we've seen this little guy running ever since, up until 2020.
That's right. So we'll show you what that capitulation looks like on our next show.
And the link for that one is right here, by the way. So go ahead and click on that if that sounds intriguing to you. Anything else we want to cover about what we think for 2023? Or that
I think we got it. I think that covers it.
Very good. So that's going to wrap it up for this episode of The Vault. Feel free to hit that like and subscribe button to catch all future episodes. And remember, as we say, the markets aren't going to wait for you. I'm Brice Payne.
And I'm Doug Ray.
And this is The Vault.